Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We'll look at the U.S. dollar that is at a key level. We'll also look at commodities, but today we're really going to focus in on some sentiment readings. We've got some things that are really at an extreme level. We're going to talk about what that could mean for us moving forward. So let's jump right in on the technical analysis side of things. Market continues to look extremely well, like we have continued to make those higher highs and higher lows now for the majority of the year. The one pullback that we did have fell right into this major support zone, bounced right where it was supposed to, and then we ripped higher and broke out to new all-time highs. Now yesterday you can see we had a little bit of an ugly action in on Wednesday out of all of the indexes when I pull the chart up, and that's one thing that we want to speak about. In a really strong bull market, both bad news and good news is good news. And what I mean by that is when you see a bad economic print or a piece of bad information that comes out, the market tends to go higher on that information. And that has been a big theme here over the last year or two. We'll get readings for particular economic pieces that look really ugly, and the market takes that as a reason to go higher. Yesterday was the first time we really saw the inflation numbers, the CPI numbers, have a negative impact on the market. The CPI numbers for the previous month came in about 50% higher than expected, and that was already an elevated number, which means inflation is continuing to heat up. And the idea here potentially is that the market is sort of stop buying into the Fed's commentary that inflation is transitory and might start to worry that it actually is here to stay. And if we continue to have those high inflationary numbers on the economic front and the market continues to sell off on those moving forward, that would be a change of character. Now, that being said, we're still where we were 4 or 5 days ago. We're still very close to those all-time highs. We haven't broken the major support level down here. So technically the market still looks good. But yesterday really kind of was that shot across the bow. And you can see very clearly here tech was hit harder, which makes sense. Inflationary environments tend to not bode well for the tech space, and if that's really where the concern is, you would expect that area of the market to underperform other areas of the market. But again, we didn't break below any sort of major or key support level right in here, right? So we're still trading above that breakout zone. And so there's no damage on the chart, so to speak, at this point. Dow clearly still above that level. When we come in and we take a look in at the Russell 2000, we're still clearly above that level. So while the action yesterday wasn't fantastic, we didn't break any technical levels. It was and can be a little bit concerning to see the markets turn around and selling off on inflationary news when we know we're in an inflationary environment. So we're going to continue to pay attention to it. But as it sits right now, not a large concern. Now, one of the other things that happened yesterday was the U.S. dollar actually broke above that key level that we've been talking about for a long time. So we've talked about 95. And here we are right there at that 95 zone. Now, it remains to be seen if we can close the week above this level, but if we did, we are now above the coronavirus spike low and the area where when we broke down from last year, right, we failed on that test again right in here and then continue to roll over. Now breaking above this is a change of character. This is a very important level. So if the U.S. dollar can hold over that 95 zone, this can be looked at as a potential, year-long bottoming pattern, and we may see some continued move higher. And it does make some sense if we continue to see overinflation. The Fed really only has one tool, and that's to hike interest rates. And by doing that, it removes money from the system, which is what the goal of that is. And that, of course, would strengthen the U.S. dollar. And so that right here is certainly something to continue to pay attention to. Interestingly enough, we saw gold have a really, really strong session. We've talked about this 1840 level for a while because we haven't been able to get over it since July. Well, we broke above it yesterday. We did it on some high volume. The next key level in on this chart is over that 1900. And for me, the most important area is really this 1950 to 1970 zone. Back up above that, this chart looks really, really good once again. So if we want to look at it as a potential, rounded bottom here over the last 4 or 5 months, that is certainly a valid way of taking a look at it. We held on to this major support level. We haven't really gone anywhere, but gold had been down year to date and was one of the worst performing assets. It's almost back to flat for the year. And again, when we look at this picture on a long time frame, on a monthly chart, this thing still looks extremely good. So that was interesting to note. Seeing the U.S. dollar breakout yesterday, also saw gold and silver push higher as well. Silver back up over that 25 level. 27 is that next level that we really want to pay attention to, right in here. It gets above that, then you've got that run back towards 29 certainly in play. We take a look at the other precious metals. Platinum, look at it. We laid this out. We said we didn't want to own it if this thing stayed underneath that 900 zone. That's exactly where it bounced from. Pulled back up. The next level we're watching is at 1150. 1150 gets broken. We really don't have resistance until we get back up towards those highs from the beginning of the year. So that is certainly worth paying attention to. Palladium didn't have nearly as strong of a session, and this market has been the ugliest out of the precious metal space, really losing almost 50% of its value from where May is. 2200 still the key, 1800 still the key support level. We're watching those levels very closely. When we take a look in at our copper market, copper is still basically flat since February. Had an incredible run. It's still digesting those moves. We're looking for that move over 480 or that move really underneath the 390. Not a whole lot's changed in on that market, so not much more to discuss. It is worth noting here, crude had a really ugly day yesterday, but still didn't break below that important level. We laid this out. This is this 80 zone. You really have support between 80 and 75, but it has not been able to get up and close over that 85 level. We've been trading inside this zone now for 3 or 4 weeks. Let's see here if we can kind of hold the bottom of this range and push back up. A move over 85 and a close above it would continue to suggest that we were going to see higher prices there out of the oil market. When we look at the big picture, again, there's not a lot of resistance between that 75 and really just underneath 100. We'll take a look in at nat gas. Nat gas, not what you want to see. We've talked extensively about this. These spike highs and then immediate moves back under these key levels is something that has plagued nat gas for the last 10 years. We finally get that big push up. We're not able to hold over it for any prolonged period of time. We've seen some very strong down moves, and we're looking like we want to get underneath that 480 level. And if that were to happen, we really don't have support on this chart back until about that 350 zone, and this could be another potential false breakout. In the last 2 times that we have seen that have been more than 50% down draws over the course of a few years. So what happens in the nat gas market here is really, really important. Now, everybody's talking about gasoline, so we will take a look at that. Right at that 240 level is the level that you need to close above so you can get that run back up towards that 3 area. Right, this zone between basically 220 and 240 is that long-term price action level. We pushed up into it, weren't able to close a month over that level, and now we're trading back kind of in that zone. So what happens here is really important. We'll continue to pay very close attention to that. Now here are the sentiment readings that we want to take a look at. We want to take a look at the dumb money confidence level, right? We are way back up over that 70 mark. It's the highest that we have seen since April, and we know that when the retail investors get extremely bullish and extremely on one side of the boat, that can tend to lead to some of those sharper corrections. It doesn't mean it's going to happen immediately. As you can see, the last couple times we've been up here, we actually grinded higher. One of the interesting things to note, all of these models that we're about to take a look at right here have not worked very well this year. Right, the amount of money that we've printed may have changed the value of these type of readings. And so I'm going to show you some things that look very negative, but again, if we take a look at what's happened here in the recent past, it actually might not matter. Next up, we got our fear and greed model. Again, if we look at what happened here this year, we got above that 80 zone here, and the market's just continued to trend higher. Other points in times it has led to pullbacks. And other points in time, it's kind of still led towards those grinds higher. So we know when we start seeing all of these pieces together showing the same thing, then it gets a little bit concerning. But again, what we've seen over the last year, these things haven't really mattered the same way that they used to. We have our panic euphoria model in the top 3% of readings for the last 25 years. So the public really is in that very much euphoric, bullish mindset. When we also take a look at Goldman Sachs bear market probability model, we've got one of the top 5% readings in the last 50 years taking place at the moment. And now when we take a look at all four of these things combined, we get some pretty negative results where when all of them are above that 80% zone, the annualized return is negative 9.2%. And the amount of time that we see readings up here is 5% or less. Right? When the sentiment models fall between that 30 to 80% zone, you get a positive annualized return. And when sentiment readings are just absolutely abysmal, below that 30%, we have an annualized return of 20 plus. Right? And we can go back and we can look at a lot of these panic lows that we have seen out of the market, 2019, 2020, go back to 2016, back in 08, 09, right? All of those saw really sharp moves in the markets off of the bottom. So sentiment has been something we look at a lot because we find a lot of value in it, but it doesn't work 100% of the time, and there always is those outliers. One of the things we have talked about extensively this last year is the amount of money printing that we have seen over the last year is historic, and it could really warp a lot of these models. So we have sentiment readings that are in a very concerning zone, but we still have markets up at those all-time highs. And what that means is we have to continue to trade the charts until they say otherwise. If we see markets start to turn and break lower, well, then we couple that with this information here, and that might mean we should be taking a more cautious stance. But until we actually see the technical levels on charts break, just because these readings are up here doesn't mean that we need to change our stance. Trade the charts. First and foremost, price action is where it's at. As always, guys, I hope you found this information useful. If you'd like, reach out to me at mtedeschi at perspectivewealthplanning.com. Love to talk anything about the markets with you guys, or you can reach me at 814-580-9881. I will see you guys next week. Take care.